Buying a home today is already so difficult for people in my age group, people older than me, and even younger than me. But what I want to do is I want to tell you, if you are in your 20s, what you need to do so that you are able to purchase a property in your future. Because the market is just going to get even more difficult. And if you make mistakes when you're younger and not prepare for the future, you could really be holding yourself back to be able to buy a property in the future and be able to grow your family in a space that you can call your own, because you are putting equity into yourself. By the way, my name is Zamira Dunnet, and I'm a local real estate agent right here in the GTA, and I'm with eXp Realty. And I'm here to just give you as much information as possible so that you are able to purchase a property now or in the future. If you have any questions about the housing market, about how to get into the market, or how I can help you, my contact information is right there in the description. I also want to tell you that my husband is a mortgage agent, so we work together. We call ourselves the Dunnet Duo. So we are here to help you through this entire process. It is not an easy process, so please go ahead and reach out to either one of us. Our contact information is going to be right here on the screen for you. We are here to help you through this crazy process, and it is just going to get even more difficult. So we want to set you up so that you are ready to take those steps in your future. So please go ahead and reach out. So let's jump right into it. Number one, and the most important, is to avoid high interest debt. Don't rack up those credit cards. Don't go ahead and get an insane car loan. Don't go take out personal loans or even payday loans. All of these things are high interest. It can put you in really high debt. And then you can also affect your credit because of the high debt that you're in. What we talk about is you want to keep the amount that you spend on a credit card or on the loans that you have at 30% of the allowance that you have. And one of my biggest tips is when your credit card company contacts you and goes, hey, we can increase your limit from $3,000 to $5,000. If you're someone that you are the type to use your credit card and go up to its max, don't take that extra credit that they give you, because then it gives you the ability to spend more. It gives you the ability to get higher debt. You want to minimize your debt. You want to pay it off every single month, and you want to make sure that the amount that you are spending is not higher than what you can actually afford. If you are going to go buy something, make sure you already have the money in your account to do so. Budgeting is super important, and especially when it comes to interest and collecting high interest debt, you need to prevent yourself from doing so. It is super important to keep that debt low so you can keep your credit high and you don't have high amounts of debt when you go ahead and speak to a mortgage agent or somebody to go ahead and see how much you can afford. Because your income might be great, but if you have all this debt, it's going to prevent how much you can afford. That is the number one tip you need to do. Don't take on that high debt. Try to minimize how much you spend so that if you are even going to buy something, go ahead and maybe use your debit card on those high charges, because you know you have the money in there so that you don't end up getting high interest for that high debt. Number two is don't neglect your credit score. We were just talking about it, that if you get high debt, it can affect your credit score. A lot of people, when they're younger, they're like, I'm just going to do this and I'm going to do that. And then it affects their credit, but that affects your credit for the long run. You need to have at least a minimum of a 680 credit score to be able to have a proper bank look at you. If you're under that, you may have to go on the B lending side. So if you want to make sure that you are in the best situation possible when it does come to getting a mortgage in the future, you want to protect your credit. You don't want to get high debt like we mentioned. You want to pay everything on time. For example, what happened to me when I was younger was I got a cell phone. And the company that I picked was not a great company. It kept cutting out in service. So I decided to switch phone companies. I did that 3 times in the span of 3 months, and it dinged my credit by 50 points each time I did it. I was able to build my credit back, but you don't know that these little things are really going to affect your credit as much as it does. So make sure you watch your credit score. Make sure that you can see if there are any discrepancies that you can dispute because they're not actually there, or things that come up that you don't agree with. You need to try to protect your credit as much as you can and keep it as high as possible so that you can make sure that you can move forward in the future to go ahead and buy a property because you have great credit. Number 3, don't overspend on luxury items. You don't need to get the nicest car on the lot when you go ahead and buy a car. Maybe get a used car. Honestly, they're cheaper and they last longer than getting something off the lot. If you drive off the lot, you literally reduce the amount that your car is worth just by driving it off the lot. It is like the quickest depreciation item that you can get. So maybe don't even buy a new car. Go ahead and get a used car. And if you honestly put payments on that you're paying monthly for a car, that could reduce your buying power by so much. You really don't want to put yourself in that situation. Honestly, every $100 car payment that you have can reduce your purchasing power by about $50,000. So if you're approved for $600,000 and you have a $200 car payment, that reduces you down to almost $500,000 for a purchase price. That is drastic in today's market. So you cannot put yourself in that type of a situation. And what I think the best thing you can do is every paycheck that you get, take out a portion and put it towards your home savings, because you need to build that down payment as well. You can't just say, I want to buy a house, and then look at your savings and have $10,000 saved. You need a minimum of 5% of the purchase price as a down payment. So you want to start putting money aside so that you can go on vacations if you want and not do the biggest vacation available. Spend $10,000 to go to Europe or something like that. You could go to Europe, but budget yourself. Make sure you are spending your money accordingly. Everything is so expensive these days that just going out and getting coffee every day can really rack yourself up. Buy a Keurig and go ahead and make your coffee at home. Number 4, avoid job hopping. Lenders love to see that you have been at a job for a few years before you switch careers. And if you're actually in the section of where you've already put in an offer on a property and the lender is looking at you like a hawk, you really do not want to switch jobs. But honestly, keeping consistent with a job and then switching a few years later shows the lender that you are steady. You are able to pay your payments because you are locked in a career and you're staying on that path. If you keep switching jobs, it's going to look like you are unable to stay consistent, which means you may not be able to pay your payments consistently. So they will really look at that and criticize that if you are the type to continuously switch jobs. So make sure you stay consistent with where you're at. And if you are going to switch, make sure you're moving to a job that you feel like you're going to stay at for a little while, because you really don't want to look like someone that is all over the place, which means they're going to think that your payments are going to be all over the place as well. And last but not least, number 5, don't neglect the importance of saving. I know you need to already save for your down payment, but there are additional costs that you need to save for as well. There's closing costs. There may be home repairs that are going to come up. And we honestly say that you need to have a buffer of 4 months of expenses in a savings account after you have purchased the property, so that if you have a rainy day or something comes up, you can still pay the payments that you have to pay. So make sure that you set up a savings plan for yourself. Go ahead and put some money automatically out of your paycheck every single month or bi-weekly, so that that money is in an account that is not touched. And hopefully you have it in a high interest savings account so that that money grows on its own, that can follow inflation, so that you're actually making money at the same time. You don't want to put it under your mattress, because honestly, that will depreciate faster than you think. So remember, you have to also save additional money than just the down payment. Hopefully this video prepares yourself to go ahead and move in the right direction to be able to purchase a property in the future. It is very difficult for people right now to be able to purchase a home, but if you prepare yourself, move in the right direction, save that money, keep an eye on your credit score, make sure that you have everything in place to be able to buy a property in your future, that is the best thing you can do for yourself. I had a client of mine who was 22 years old and was able to buy her first home with me. And I think that is the best thing you could do for yourself because her home value has gone up already, and you want to be able to gain that equity instead of putting your money towards renting. So hopefully this helped you. If you like this information, please go ahead and subscribe to my channel. Go ahead and like this video, and we'll see you guys all next week.